welcome to the More Global M&D Summit Series. I'm Mark Fagan, the More Global Industry Leader for Manufacturing and Distribution, and a partner at Citrin Cooperman, based in New York City. I'm here with Sylvie Gadant, Head of Citrin's Transaction Advisory Services, and Phillippe Craninx, Chairman of More Corporate Finance, based in Brussels. We're here to talk about buy and sell transactions over the last 12 months in the M&D industry. But first, I want to bring a few things to light, a few facts that may influence our discussions. Recently, the World Trade Organization predicted a 9% expansion of trade in 2021 after a 7% decline in 2020. But in the M&D sector, many M&D companies did very well in 2020. In fact, in a Citrin Cooperman 2021 survey, which was taken in April of 2021, the survey respondents, 78% of them said they had products that sold significantly better in 2020 than they did in 2019, and 66% introduced new products in 2020 because of COVID. But it's not business as usual now, as everyone knows. The survey respondents also said that supply chain disruptions and the shift to e-commerce have forced a lot of M&D companies to change their business models. So this is complicating what's going on in 2021 and beyond. And at the same time, a survey from ACG, the Global Association for Corporate Growth, reports that there's $1.7 trillion of dry powder available right now for PE firms as we come into 2021. So that's going to make a very interesting 2021 across the entire globe. So, Phillippe, let's start with you. What have you seen in your geography, and how does some of those facts kind of affect what you've seen?
Thank you, Mark, for the introduction and the question. It is clear we are living a pandemic, and it is clear that there is plenty of money in the market. Has been before the pandemic, but it has increased with all the money flown into the economy by the central banks. It is also clear that a lot of communication we are reading and a lot of research that is done is focusing on the effect of Corona on the economy and on our businesses. In Europe and in my mind, of course there are some short-term effects of the pandemic, but most of the time what you see is the acceleration of other elements that play a role in the evolution of the economy, whether it be the M&D or other industries. To give you an example, it is the evolution in technology or in consumer behavior, regulation, all play a role. And especially if you look from European perspective, we have experienced first with Brexit and then with how China is developing its Belt and Road Initiative. We have experienced with the vaccine discussion between Europe and Great Britain, between Europe and the United States, a political effect on what is how the economy is structured, on how companies should be yes or no protected. All those elements, so the technology, the consumer behavior, the regulation, the political effects, play a role on the evolution in how companies look into acquiring other companies, look into their future being part of an integrated system or not. So yes, Corona and the pandemic have an effect, but in my mind, it is accelerating other effects that you see in the markets.
Gotcha. But M&D as a whole, had a pretty good year in 2020 despite COVID, and so it really has made it really different across the subsectors. But then when you get into transactions, so here we are a year and a few months away from the start of COVID. As far as transactions and where the M&A market is right now, as we sit in, almost halfway through 2021, Sylvie, how does that compare to 2020 and maybe different parts of 2020 from a deal volume?
Right. Great question. So I went to my last M&A conference on March 9th of 2020. The world was still open at that time, and then everything shut down a week later. And we were, joking around, about travel restrictions. But a week later, everything shut down. So that's really what happened. Is we were in the middle of several transactions. Everything paused. Everybody had to reassess whether to do a deal or not, what was going on, and really, a lot of companies, turned to survival mode. Like you said, there's companies that lost everything. The service restaurants, and the restaurants were closed on Monday, so you kind of had to reinvest yourself. So the focus of attention was really on survival mode. For a lot of our private equity clients, they help their portfolio companies with accessing PPP loans in the U.S. So or providing some additional capital. But little by little, and I have to say, really quickly, the M&A activity started to revive again in May and June of 2020. And then it's been picking up ever since. We always busier in the later part of any year just because of timing. A lot of business owners want to sell before the end of the year, sometimes for tax reasons. But we were extremely busy, starting, September on. And then what usually happens also, all timing, is January and February are lighter months from an M&A standpoint, because again, a lot of deals get pushed into 1 year. So January is not as active, but it kept on going. And as of right now, we're extremely busy. And from every conversation I have with investment bankers, M&A attorneys, or even some of my competitors, it's an incredible amount of M&A activity, and I'm talking about the US. So I think there's a couple of things that come into play. Is one, there may be a change in the tax law in the US, which may be driving some increased level of activity now. But I would have thought that it would come later on this year, not right now in April and May of 2021. And the change in tax law means that the tax rates on capital gains may go up. And if so, if you sell your company in 2022, you make less money, or come up with less after-tax cash proceeds than if you sold it in 2021. So that's one factor. I really think that the second factor is you had pre-pandemic, we were in a seller's environment. Again, jokingly, we were in the 10th year or 12th year of the 7-year recovery cycle. So it kept on going up and up and up. And we were like, when is it going to end? And this pandemic, we thought, would, again, put a chill on the M&A activity. But it hasn't, because what happened, I really believe, is, again, it's my opinion, is that business owners that went through the pandemic, that had thought of selling but weren't really committed to it, now are fully committed to selling their business, or taking having minority or majority partners and looking at a potential exit in a 2 to 5 year span. But now they want to sell now. They don't want to go through another pandemic. It was extremely stressful on them, their family, their staff, their employees, their management team, and they don't want to go through that again. So I really think that is a higher level of motivations from business owners to sell today and not later. And I have to say, I have many conversations with clients, again, in private equity professionals that do this day in and day out. And I do remember that, one of them said, there are going to be a tsunami of deals in the later part of 2021, because also from a timing standpoint, you would have the trailing 12-month results that wouldn't have any pandemic impact, because basically the impact of the pandemic on a lot of companies were from like March, half of March, and then through maybe July or August, when things started to reopen in some states, right? So then, if you get about almost 12 months of data, then you can show that, your company fully recovered and you should capture more value. But that's kind of a state of the market today. It's the highest level of activity I've seen in my 20 years doing this.
Yeah, it's really interesting because these multiples, I remember doing an interview in 2016 about how long are these multiples going to last. They were stuck at 5 and 6 and 7 times EBITDA for a long time, and we started creeping into the 8, 9, 10 times EBITDA, and that's been going on for so long. And the busiest I've ever been with transactions was in 2020. And it is, I agree, in the United States, definitely tax rates have to do with some of the acceleration. Also, once all of a sudden we have the Democratic, a Democratic White House and more influence, so they're worried about the capital gains rate. Also you have these baby boomers that are retiring and want to cash out, and then you've got this private equity that just continues to be this monster supplier of capital. So it's really something that's amazing, and it didn't get slowed down, especially in the M&D industry with COVID. Phillippe, what about in the UK, in Europe? Is it as feverish as what Sylvie's talking about?
From our perspective, there are a few elements that play a role, which are comparable, and a few maybe that are different. First of all, it is the same in Europe. You have specific industries who suffered, or subsectors who suffered from COVID. You have other subsectors who were not that much hurt, and you have certain subsectors who benefited a lot from the pandemic, and because of the change in behavior of their consumers. Just as Sylvie told, that's the same in Europe, I guess, than it is in the United States. What is probably different when I hear the 2020 overview Sylvie gave is that we experienced in Europe a second wave in Q3, Q4. So the reaction was a little bit different. The world stopped in April, clearly. Q2, what you saw is that the bigger deals went through, because that's something we have as an experience. That is, the bigger the deal is, the less the personal feelings have an implication on the deal. Whereas the smaller the deal is, or the closer you come to a family-owned businesses, then the instincts of the person, the people that take the decision, becomes more prominent. So Q2, you saw the bigger deals go through, the smaller deals being frozen, just frozen because of uncertainty in the market. It picked up during summer. It was where we thought summer would be a normal summer, which is less deals, more time for vacation. The opposite proved true, because the world in Europe got a little bit liberated, and people wanted to pick up businesses. But then came the second wave, and with the second wave, every really stopped. And it only picked up by December, January this year. So the curve you see in Europe is slightly different from your experience. So that's the second I wanted to say. The third on the multiples and on the availability of cash, that's very comparable. It is the combination of a lot of money into the market, and you're talking about private equity, but the same applies. We lived over the last 3 years the first time in history that private equity could outbid industrial bidders, because in the past, the longer past, the industrial bidders had the synergy, all the value drivers that they could put into the balance when they looked into the pricing of an acquisition they wanted to make. The last few years, you saw private equity able to outbid the industrial buyers, and that has increased over time. At the same time, I must add to that the industry of the private equity. So the private equity industry and the value they're adding to the companies they are acquiring has improved also. You have seen sector specialization, you have seen buy and build strategies, you have seen kind of value added brought into the playground by the private equity spillers in Europe.
Yeah, and that's one thing that we're going to talk about soon is also private equity versus industry buyer. And I've seen a lot of private equity, and we can talk about that. But if we start talking about the deals itself, I'd like to touch upon the intensity of the deals in 2020. And I don't know if this has been, if Sylvie, you think this has been like this for a while, but in the past 12 months, it just seems like the number of private equity transactions going on, the size of the deals, the size of the multiples, right? So the enterprise value is just getting higher and higher, creates more stress, more at risk, especially for the private equity that's got to, if they're buying at a high price, then they've got to flip it and increase value for their investors, or else there's not going to be any investors anymore for them. So is that creating a intense competitive environment, and do you feel that in the services that you're providing to your clients?
Yeah, I mean, I think it's not just the past 12 months; it's really the past 12 years and beyond that have been intense. In terms of the EBITDA multiples, I want to be careful because size matters. If you have and a threshold in the US is like $5 million of EBITDA. Below $5 million, it is extremely unlikely you will get 8 to 10 times multiple. It will be more the 4 to 6 times multiple because you're smaller. There's more risk to your business. Maybe sole owner, founder, business heavily reliant on maybe a customer or a particular supplier. So there's more risk in smaller businesses, and they tend to be valued at lower multiples. But beyond 5 million, if you had a 10, 15, $20 million EBITDA company, 8 to 12 times is not unreasonable anymore.
And do you see it as intense, Phillippe, in Europe and in other parts of the world that you deal with, as far as this just the multiples being so high and the stakes so high?
I wouldn't be myself, Mark, if I wouldn't start by saying beware of multiples. We use a lot of multiples when we're talking about deals. Sure. But at the end of the day, nobody is buying anything based on a multiple. I mean, if you go into the negotiations, whether buying, whether selling, what you want to do is to have a good insight in what you're buying, the profitability, and what you can do with it in the future, and what the cash out will be. So at the end of the day, it always comes to earning money. And the problem with the multiple is, Sylvie mentioned rightfully that size does matter, industry does matter, growth does matter, risks do matter. So you have a lot of elements that influence the number that will be, at the end of the day, the multiple that will be on the table.
So we spend a lot of time with our clients over years preparing them for sale. And there's a lot to do to maximize enterprise value. And I'd like to talk about that a little bit, because I think that's some really valuable services that we provide to our clients. Sylvie, before someone wants to sell, what kind of advice do you give them? And let's say that, we're not talking about 6 months before they sell, but maybe if they've got the benefit of spending 3 or 4 years to sell, what can they do to maximize enterprise value?
Yeah, so to me, it may not be 3-4 years beforehand, but when you're looking to sell your business, you just want to make sure that you have the right team in place of advisors. But the number one role in that team is hiring an investment banker to run a process so you can stay focused on running your business. And again, the investment banker can do a couple of things. Is one, and ideally, you want somebody, a group that is, in your specialty. So M&D, but in your specialty, that knows the buyers, the environment, the current M&A environment, who's buying, who's selling, what type of multiples can you expect, but also they would run the process. They would negotiate purchase price. And again, so you can focus on your business. So the number one thing that, if anybody wants to sell, they should hire an investment banker. But in terms of getting ready, there's a couple of things, and one of them, probably could talk about this for an hour, but one of them that I want people to focus on that is critical, but sometimes overlooked is working capital. So when you sell your business, we talked about EBITDA multiples, right? It's, you sell 10 times EBITDA. You also have to realize that when you sell your business, you're going to leave the working capital with the entity that's buying your company. So a lot of business owners think that I'm selling my business, but I keep my receivables. No, you don't. You can't keep your receivables. If I buy your business, I need to make sure there's cash coming in on day one to pay employees and purchase inventory and pay suppliers. Right? I can't start with no receivables. So there is a certain level of working capital that comes in. It's all transactions are done on a cash-free, debt-free basis, meaning the owner keeps the cash, and they also have to settle all the debt, all interest-bearing debt. But what's left is working capital. So for a manufacturing distribution company, it's big dollar items are in accounts receivable, inventory, and then on the other side is going to be payables and accruals. And when you think about it, you have to deliver working capital at closing. Well, the buyer and seller will agree to a net working capital target or a net working capital peg. So it's a certain level of working capital that the business has to be delivered on closing, and it's a pre-negotiated amount. So if on average, your working capital was $10 million and you agree to deliver $10 million at closing, that's the amount of working capital that needs to be delivered. If you deliver less, let's say $9 million, then you're going to owe the buyer $1 million. If you deliver more, $11 million, you get another $1 million in cash. So the working capital is critical in maximizing the amount of money that you make on close. And I want to make sure that business owners do not forget about that. And it's something that you can prepare for ahead of time, because a lot of times for small to mid-size M&D companies, the working capital is not really well managed. The receivables, when you look at collection days, it's greater than the terms on the invoices. So, chasing your receivables would make sense. Managing your inventory to the optimal level is also critical to make sure you don't sit on a lot of inventory. And then what's funny sometimes is you have companies that are, profitable, do well, and they actually pay their vendors before the due date on the invoice. So again, when you think of all those factors, is, won't chase your customers, your receivables will be higher. You don't manage your inventory, that's going to be higher too. You're lowering your payables because you pay your vendors too early, and all of that, the net amount will be a greater number. And again, when we try to set a net working capital target, we're going to look at trends over at least 12 months, but probably, we try to get, 2 or 3 years of data. So if you manage to, again, maximize, collections, manage your inventory to a more optimal level and make sure you pay your vendors at term, and you have like the optimal level of working capital when you get to close, that is fantastic. That is a tough thing to say when, you're a couple months out or a couple weeks out and you say, you're buying my company, but really the your receivables should be at 60 days, not 120, and my payables, my inventory should turn faster. This is not going to fly. They're going to look at historical data, and usually it's the past 12 months, take an average, and that's going to be the start of a conversation. So if there's something that business owners can do ahead of time, One thing to focus on would be working capital because it's oftentimes overlooked. Another couple of things that I highly recommend, and it's kind of a new trend over the past 5 years that actually came from Europe, is doing a sell-side due diligence report on the company before you go to market. So in the US, 10 years ago, talk to a buyer, they would do due diligence on you. So they, hire a firm like, Citrin Cooperman that would do a financial due diligence on company, look at, how much EBITDA on an adjusted basis is reasonable, working capital, how much there is, and maybe come up with some findings that may reduce the purchase price. So that's never good. Or sometimes, find issues and the deal dies. So that's not good. So what's been happening over the past 5 years is more and more, and really the push has been from investment banks, is to do a sell-side due diligence before you go to market. So hire a CPA firm like ourselves to do the same report we would do for a buyer, but we do it for the company. And it does a couple of things. Is one, your numbers. They'll stick during somebody else's due diligence. If there are any issues that we pick up on, they can be fixed ahead of time. And it really avoids surprises and, risk of the transaction not closing. So again, what tends to happen when we do a sell-side QFV is that you actually will close more than likely at the offer price and quicker. Because when you think about it, when you hire somebody to do due diligence ahead of time, it will minimize the amount of due diligence that a buyer will do because we're going to give them a package fee we do anyway. They're going to review it. They may hire another firm to ask some questions, but the whole process will be way more smooth and fluid. And again, there's less risk that can be entered into the M&A process. So it's just a great idea to do, and it's a trend that's been increasingly increasing over the past 5 years. A second point to that, which we started to do more recently, is doing, and it's really for U.S. companies, sell-side state and local tax due diligence preparation. So it's looking at how a company complies with state and local tax laws. And again, in the U.S., you have 50 states that tax things differently. And it's very complicated. It's so complicated that we have a team of 15 to 20 people.
Probably, yeah.
That do just that. That's their expertise. We call them SALT, state and local tax. So they're our team, and they know everything that everything everywhere that every state and other tax jurisdictions tax companies. And again, the rules are different per state, and they also change all the time. So the thing is, what we find a lot of times is that those, small to mid-sized companies usually are not fully compliant. And, one of the reasons for that is there was a change in the way that nexus was defined in June of 2018 with a Supreme Court ruling that's called the Wayfair ruling. And, essentially instead of, and nexus means, it's when a state can tell you, well, you should pay income tax to my state, or you need to collect and maybe remit sales tax to my state. And usually it's based on, having employees in the state, inventory in the state, or having an office in the state. Well, that makes sense. If I have people or inventory, that means, I probably should pay tax in that state too. But sometimes you don't have any of those factors, but you do business in the state. You generate a lot of revenue from that state. So the states got smart. Again, there was a Supreme Court ruling that the state of South Dakota won, and now you have 14 states that actually can tax you even though you don't have any employees or office or property in a state. So the change in that law is still pretty recent, and a lot of companies haven't caught up. So again, I think it's critical to sum it up. Reduce the amount of working capital that you have on your books, and then two, probably closer to your transaction date, is to do some type of sell-side preparation prior to going to market.
You think of a working capital peg and, that target that you want to set, you think it should be pretty simple. It can be incredibly complex. And with a manufacturing company, it's unbelievably complex. And, a company that's, maybe again, privately held, is tax oriented, may not be thinking about inventory reserves and AR reserves and some of these things that are frankly inflating their working capital higher than it should be. And that's just, that's just could be a real issue and take dollars off the table when you're going to sell your company. So it's really a big thing that has been very hot in all of my deals is sell side QOV. And it's amazing. Working capital is always a side of contention in every deal that I do. And Phillippe, most of the deals in the States involve some type of rollover equity, especially the big deals. So even though you're not selling 100%, and then the owner is going to have rollover equity into the new company, which could be very very good for them, especially if it's a platform company and they're going to build and so forth. So I think some of your recommendations have that in mind as well. Could you talk a little bit about what you think owners should be doing before selling their company?
With pleasure. I was listening to you and Sylvie, and I was thinking we in Europe, we are softies. We have a lot of other things that we think about besides the money. Because
True.
You're selling a company, you're selling people you've been working with for decades. Yep. You're selling maybe part of your family, and you're selling your future. And of course, the money is important, definitely. I mean, we are softies, but not stupid. The example I'm always giving when you see an SPA, share purchase agreement, I don't know whether you use this term in the United States too. When you have an SPA, the figure that is paid for your shares is a series of numbers. And still, there are hundreds of pages filled with other words. And they are there for a reason. So when I'm advising clients that are considering a sale, of course, you need to prepare. And of course, you need to have a good look into the value drivers. And Sylvie pointed out the gap in between enterprise value and equity value is an important one you can work on, as well as the sort of the company. A vendor due diligence is very important to look into a series of risks and how you can mitigate the risks. Structuring, like you have the SALT, the STOLT you talked about. The same applies here. Your structuring needs to be right, but it starts with exactly knowing what you want. Do you want to sell? Do you want to sell 100%? For how long do you want to have a commitment afterwards? What kind of amounts you are prepared to reinvest? And what is the partner you want to spend the next 5, 10, 15 years with? And it's really depending on this type of reflection that you enter into the process. So after the preparation comes the strategy of finding the right buyer. And the right buyer is, in fact, responding to a few criteria. The first criterion, when you look into price maximization, the right buyer is that buyer for whom your weakness is not important, because that's his strength. And your strength is important because it's his weakness. So in defining the ideal buyer, you need to have a good insight in your SWOT, hence partly the vendor due diligence and the analysis, but also the analysis on the long list, the potential buyers, the potential parties you want to discuss with. And I guess it's in North America the same as it is in Europe. You have not only the difference between private equity and industry, but within the industry you have subsectors, and within private equity you have subsectors. Now, second in the ideal buyer is the company culture. To what extent does the company culture of the party you will be teaming up with in the future correspond to yours? Because there's been a lot of research done on, and it's a topic in Europe, on the destructive value of acquisitions. Until the 2000, around that time, there has been a lot of research saying that 1 + 1 is not necessarily 3. It can be 3, but you may end up at 1.5. In order to make sure that you are building value together, especially, and that was your question, Mark, if you're reinvesting part of the proceeds, you want to make sure that you're building value. You need to make sure that the combined entity of the buyer and the company you're selling is producing more value than the price paid. And hence you want to have the maximum price paid to you. So there you have a little bit of in thinking of how am I going to make sure that we create value together into the future. So second element, pick your buyer. The third element is, and I fully subscribe Sylvie's first recommendation, take a good investment banker, take a good advisor, because the way you manage your process is vital to where you will be ending up with. It has to do with the tactics of the negotiation, but it has also to do with the structure, has also to do with the reinvestment you do as a seller. And last, the reinvestment in your mind, make the distinction between 3 elements. First, the amount. Second, your role. And third, your ambition. I mean, you need to reinvest a certain amount, but what will be requested from you as a role in the future? And does that fit your ambition?
Right. Yeah, no, those are all really good points. And, several of them, especially with the rollover is a huge part of deals that we've been seeing. And it also makes sense because if you spent your life building a company, you want to make sure that it continues, even if you're not part of it anymore, and your employees continue in a good place, because that is one thing that can be tough if private equity is buying and wants to maximize money on the flip. It's the employees could end up in an environment that they're just not used to, and it could be difficult for them at times. So let's go to the other side, and sometimes the answer is the same, but I think there are different answers as far as if you're looking to buy a company and now absorb that company into your own culture, or maybe not into your own culture, but when you're doing buy-side quality of earnings, Sylvie, what are you looking to provide to your clients?
Sure. For again, focused on the M&D, like I can think of 4 things that are kind of critical. And we're going to talk about working capital again, so I'll keep that one for last. The first 2 points, and I'll go quickly through them, is a lot of those companies that at least my clients are buying are family businesses. So we talked about family. It's not just about money. The company is also part of a family, right? So, but also what that means is 2 things. Is there's probably some level of what we call owner discretionary spending, and it could be excess compensation to the owners. It could be family members on payroll that may not be working a lot. They may get their health benefits from the company. It may be some more personal, expenses in nature that, again, under a new ownership would go away. Or even sometimes donations to, the community that, the family, which might mean a lot to the family, even though it's not technically an essential business expense. So, those, again, buying in a, family business is as, a different characteristic that a buyer would need to consider. And the other point which Phillippe, touched on is the reliance on maybe family members running the business, and what if they stay on? It could be, 2 brothers and a sister that own the company, and their kids are involved at the management level. So it's very important to them that they continue on. So again, buying a family business, some things to think about. For M&A companies, when we do buy side, I don't want to be too technical. We always look at revenue recognition, but really the one accounting policy and procedures that we spend most time on is really cost accounting. So it's how you cost your inventory, and there's a lot of different ways in the US to do that, and it leads to different results on the balance sheet and on the P&L. So we need to fully understand how the company does it. And again, it impacts your inventory, it impacts your cost of goods sold and your gross profit margin and your EBITDA margin, and working capital. So, but again, and then jokingly, a lot of those are small to mid-sized companies. So a lot of times we don't deal with US GAAP. They use Texas GAAP, California GAAP, New Jersey GAAP, but not US GAAP. So that's just, I'm jokingly, we just listen to how people do business and how they record things, because it's always different. And we try to figure out, how close it is to US GAAP, and do we fully understand, how things are recorded and the impact on working capital and earnings. So that's the second point. The third point, which is more timely, is a lot of those companies now have COVID adjustments. There's two types of COVID adjustments. There is the easy one-time expense, could be PPE, cleaning supplies, some additional, again, expenses you incurred because of the pandemic to get your employees back in the factory or continue to operate. So those hopefully are one time now that the CDC said you don't have to wear a mask if you're vaccinated. That's an expense the business need to have, right? So those are one time and they're easy. A lot of the COVID adjustments that we spend more time on are pro forma normalization type adjustments. So for example, you have businesses that said, from April to July, this customer was shut down, so we didn't get any sales from them, but they came back. And look, the sales return after, they came back to work. So, we'd like to get credit for our revenue. So there's a revenue adjustment and maybe a cost of goods sold adjustment. Or it's possible that they received some, a PPP loan, so some help from the government. It's a, 0% loan that was 1% loan that's eventually forgiven by the U.S. government if you meet some criteria, again, in the U.S. But it's possible that they kept everybody on payroll. But if it wasn't for the PPP loan, they would have maybe let go of some of their workforce. So again, they're maybe less profitable, but there is a reason for that. So all those things, all those COVID adjustments, we spend a huge amount of time on, and it's something that's different than any 1 year. So that's point number 3. And then point number 4 is, going back to working capital. So if you're a buyer, never think it's a good idea to agree to some type of definition of working capital, or even pre-agree to a target in the letter of intent. It's a really bad idea because, like you said, Mark, it's very complex, and once we get into the detail, it's not an easy. It's just never an easy answer. One thing that makes it very difficult is having some level of deferred revenue or customer deposits on the books. And I want to spend a little bit of time on that, if that's okay, because it's an issue that we see on a lot of the transactions. I had a private equity client that actually sold one of their M&D company, and they grew extremely fast in 2020. And to finance their working capital, they use customer deposits / deferred revenue. So they pre-billed or got deposits from customers so they can buy the inventory and pay their people to do the work, right? So they had a tremendous need for working capital and couldn't raise capital fast enough, right? Because their working capital was growing. So again, come to closing, it's, how do you treat deferred revenue and customer deposit? Is it part of working capital, or is it really debt? And again, when you think back as to what I said is, when you sell a company, you keep the cash, but you have to pay off the debt. And one of the trick is, there are a lot of things that we call debt-like, meaning they're treated as debt, even though they're not interest-bearing amounts on your balance sheet. So again, a good one is customer deposit. It's cash you get in advance of providing a service or delivering a product. And again, cash in advance, you keep the cash. Well, it wouldn't be fair to me buyer, if you seller keep the cash, I have a liability, and then I don't have any cash to, again, buy inventory or pay people to do something. So leave me the cash. But again, the other side of the argument is, well, I actually used, even though I collected the cash, I used it already to buy inventory or equipment or pay people. So, that customer deposit, and, let's treat deferred revenue and customer deposit the same way. The difference is deferred revenue is, sometimes recorded, it's still sitting in your accounts receivable, but sometimes it's collected already. So, but, let's put them in the same bucket. So again, deferred revenue, customer deposit, I already collected it, but I used it, so I can't give it back to you. It's sitting in my inventory, so I'm not going to give you the cash. So again, there's the two sides of the argument, and sometimes most of the time we get to a happy medium somewhere in the middle, where you think of maybe what's the remainder cost to perform or deliver a product, and how much cash you need to do that. So. But those can be, and Mark, I'm sure you've got a few of those, but those can get contentious. So you want to make sure that both parties are very calm when we start talking about this, because we're talking about huge dollar amounts. We're talking about multi-million-dollar type situation here that impacts the purchase price by the same amount. Again, working capital, very complex topic. Don't agree to a definition ahead of time. Make sure you spend the time during the due diligence process. And I have to tell you, we on some deals, we spend just as much time on working capital as we do on EBITDA. And we actually communicate ahead of time with the other party, whether we represent the buyer or seller, this is our viewpoint and, how do you see things? So we can get you a good place.
Yeah, and what's really surprising is, even though maybe a working capital adjustment is 5% of the purchase price, the buyer or seller they don't look at it as 5% of the purchase price, or it's really, they look at the dollar amount. So it's like, look, and if they get disappointed, in the fact that, all right, not that I had to pay 2% more or 3% more. It's like I had to pay $1 million more. So that's $1 million more that I would have had to buy inventory or hire another person. So yeah, it gets very personal, and it can get very contentious when, like you said, it's complex, and it's things that, coming up to buying or selling a business, a normal business owner really wouldn't think about these things as could hurt them in a sale, so or a purchase. Phillippe, how about buying companies in Europe and in other parts of the world? What are you seeing as critical?
I think how to say it, what Sylvie described is the same in Europe. You look into the details, and you have the same type of discussions, because the basis is the same. The layer I would like to add to that is that when we advise about a company that is buying, of course you need to make sure that the techniques are right, that your SPAs will negotiate it, that your audit, your due diligence is well performed and brings out what needs to be brought up. But it really starts with buying the right company. So before you start to negotiate, make your homework. What are the criteria? What are you looking for? What are you really looking for? Then make sure you have the right shortlist. And when you look into the company that you're talking with, the target, make a good analysis of not only the risk, not only how you calculate the purchase price, because you're absolutely right, Mark. Even if it's 5%, I mean, in a normal return you would want on an investment is a multiple of that on an annual basis. So that's important, because it may break the deal at the end of the day, because people are thinking it's $1 million. But you earn the money the day after with finding what you want to buy. And you earn the money by having a good integration plan, which is respecting the people, which is respecting the strengths of the company you're acquiring. So please take your time to make your post-merger integration plan in detail. be sure you discussed it with the people concerned. The due diligence in itself is very important. Historically, due diligence was meant to make sure that you are delivered what is promised. So you look into the details and you make sure that there's nothing hidden. It evolved over time into making sure that you are identifying the risks in what you're acquiring. And in the recent times, it has gone beyond that in looking into are the value drivers that you have been promised, are the value drivers you're looking for real within the company? It's the figures, but it may be intellectual property, it may be capacity, it may be people, well, it may be different. So during the process of the due diligence, over transaction services over the time has changed from, in Europe, it was called audit, looking to the books, into the full transaction services that we have now. That's an important one. When we look into one of the elements that I'm always putting on the table with my client buyers is that you earn the money after the deal. So your post-merger, your integration plan is very important. And part of the transaction services process, it should be that you look into the value drivers, the reasons you're buying the company for, be it the people, be it the production capacity, be it intellectual property, and make sure that it is there. Another element is that inevitably, after every deal, there will be problems popping up. You know them sometimes, and sometimes you don't know them. Part of the transaction services, the due diligence work, is identifying risks, look into the way you can mitigate these risks, you can cope with the problems that will be popping up the day after the transaction. So this is the last part of the layer I wanted to add to this insight, is the post-merger integration process to be well prepared, discussed thoroughly with your people and with the target or the people of the target that are important to you, so that you can cope with risks.
And that brings up another question, Phillippe. If you've got a strategic acquisition, so meaning that one company is buying another company and putting them in and into their operations, or even if they're keeping them separate, we call it in the U.S. we call that a strategic buy. But related to let's not talk about the strategic buy. Let's talk about the private equity buy, where the private equity company is going to purchase either all or a significant ownership stake, like over 50%. Do you see most private equity acquisitions as the private equity company being purely a finance partner, or do you see them as also adding operational expertise and industry expertise to help that company being acquired get to the next level? Which do you see both, or do you see one more than the other?
The private equity industry in Europe has become very mature over the last decades. Until say 10, 20 years ago, the value added of the private equity was to bring private equity. With the large amounts of money that flooded into the market, we discussed about it earlier during this panel discussion. There has become an increasing need for the private equity firms to differentiate themselves, to make sure they bring all the value-added aspects to the table. And what you see in Europe is a segmentation in what they bring to the table. So it's not only the two elements you mentioned. On the one hand, operational excellence. On the other hand, money. They can bring to the table a multiple aspects of how to make you help growing your business in the future. And yes, it can be operational excellence, but the differentiation they are making is to start with the beginning, they are looking into a different type of company, type being probably size or industry. And those are the two major drivers. If you look into a relatively small company, the owner who is selling, the buyer may be he rolling over, but most probably maybe his successor, and him taking care of a succession period. In any event, this type of company is looking for another type of value added than when you look into a large company that is in going into negotiations with private equity. We talked earlier about the buy and build. In order to do a good buy and build, of course, you need to understand the industry drivers you're investing in, definitely. You need to understand what is creating value, what will be the evolution, be it technological, be it consumer behavior, be it whatever. Of course, you need to do it, but you don't need to be able to run the company the same way the management is doing it. You need to be adding something on top of that. And the adding on top of that can be all kind of things Sylvie has been talking about, like how to control working capital, how to control the amount of money, how to create shareholder value out of the operational value you are creating. That can be part of it. How do you finance your acquisitions? How do you structure your acquisitions? How do you make sure that the people who are running the businesses you want to integrate into your business are motivated to do so? So this is another type of value added that the private equity firms can bring to the table. It is definitely so that the most private equity firms in Europe, but when I'm saying the most, I'm implying not all, most private equity firms in Europe are either closed funds, so with a duration that is leading to an exit in, they always pretend to be 4 to 5 years. But what you see in Europe is that you do have the return of the old-fashioned holding companies that are either stock quoted or family owned, and that invest into businesses for the long term, so with an undefined horizon. So they bring to the table, it's still private equity at the end of the day, but they bring to the table not only either the sector or industry expertise, not only the money, not only the knowledge how to build your company, but they also bring to the table another time horizon.
That's interesting. Yeah, that's interesting. I haven't seen, in my experience, I haven't seen that long of a buy and hold. Sylvie, and obviously in the States, they're like all over the world, the private equity companies want to protect their investment and want to help them with finance and so forth. But do you see your private equity clients getting very involved at the operator level with their acquisitions?
Yeah, it's I think the question you're trying to say is for the same amount, if you have two private equity firms offering the same amount of money to a business owner, which one does he or she picks, right? So I think there's a couple of things. I really truly believe that even though we're talking about money, it's really based on people doing deals, right? So is there a relationship there, and is there a trust in that relationship? Do you share the same values? Because at the end of the day, you're going to do a deal. You're signing a piece of paper with somebody else, right? And you decide to get married for a while, maybe, or again leave your company into somebody else's hands.
Yeah, so leave your baby with somebody else.
It's your baby, whether it's a family business or not. Right. It's still your baby for many years. Right. So I think the number one thing is that that chemistry, probably more than anything else. Again, outside, putting the money aside. And then, when you think of private equity firms, I mean, there's no question that they just bring more than just capital. They do have either operating partners on payroll or as consultants to help them. Again, if they have an M&D focus, to help them with, supply chain management, finding the right executives to run the company going forward. If you need to fill in some holes in your management structure, maybe growing, in the U.S. or internationally. So they have over the past 20 years, I'd say, the private equity firms have become a little more professional in terms of bringing on that operating expertise, either on staff or again as a consultant. But at the end of the day, they're starting to all do the same thing. So now it's money. I also got, I can help you grow your business. But at the end of the day, it's going to be, can I introduce my family to you? Right? Is can I trust you? Do we share the same values?
Right. Yeah, and that's because at the end of the day, it is people. It is people. Well, Phillippe, Sylvie, this has been great. I really appreciate the time. You guys gave some fantastic insights, and I think this is ever evolving. So look forward to doing this again.
All right. Thanks for having me.
It was a pleasure.
Yeah, it's great.